The one thing pretty much everyone knows about investment bankers is they work ridiculously long hours, but they also get paid a lot. Have you ever wondered what exactly do they work on for all of these hours and who's paying them so much? Well, in this video, I'm going to talk about the reality of working in investment banking, and specifically the reality of working in mergers and acquisitions investment banking, which is my department. And if you are interested in going to investment banking or mergers and acquisitions, then this is going to be arguably one of the most important videos that you can watch. Firstly, working in mergers and acquisitions, abbreviated as M&A, is very different depending on which side you're on. You're either on the buy side or you're on the sell side. Now, this is very important, so let me explain this. Sell side investment banking is when you are helping your client sell their asset, sell their company, their specific division. Now, you can pretty much think of this like a real estate agent. If you want to sell your house, you go to a real estate agent where they're going to value your property, they're going to market your property, and they're going to find prospective and qualified buyers who are interested in buying your property. Now, likewise in investment banking, if you want to sell your business or a part of your business or certain assets, you'll go to an investment banker. And that banker is going to value your company, your business. They are then going to market your business to pre-qualified buyers or investors. And just like the best possible case scenario, if you are trying to sell your property, is to have competing multiple buyers who are interested so you can get a bidding war started. Likewise, in investment banking, it's the exact same thing. The ideal scenario is to have multiple buyers who are interested in buying your business, your divisions, your assets, so that you can actually get a bidding war started. So you can pretty much think of investment bankers as glorified real estate agents, although we'll never admit it and you should never actually say it to anyone. But the reality is investment bankers and real estate agents pretty much do a similar role. The only difference is the size. A real estate agent might sell a house worth a couple million, a couple $100,000, but an investment banker might sell a business for a couple billion, a couple $100 million. So it's the size of the actual product that we are selling. That's what makes the difference. Now let's talk about buy-side M&A, which is the opposite of sell-side M&A. Now remember, sell-side M&A is when you want to sell your house. Buy-side M&A, again, using the real estate analogy, it's when you want to buy a house. So you can pretty much go to a real estate agent and that person can advise you on the current situation of the market, how much you can expect to pay for a house, and where are the good deals, and how much is a square foot in a particular area. Likewise, a CEO that is in charge of a business but is struggling to grow their business and needs to find new revenue stream. So instead of organically growing their business by increasing revenue, reducing costs, they can inorganically grow their business by acquiring another business, by acquiring a new revenue stream, a new market that they can actually go into. So they'll go to an investment bank and say, I want to buy a new business. I want to buy a business which will complement our industry, our business. So the investment banker will pretty much advise them on how much they can expect to pay, how many businesses are for sale, and if it's even feasible to actually buy certain companies. Now there is one slight difference on the buy side, because you won't typically find CEOs or CFOs going into investment banks and asking them what companies are for sale. Typically speaking, a lot of these investment banks, they will be pitching these companies for specific deals. If the investment bank is aware that there's a business up for sale, or if the valuation of the market is pretty high, they'll actually go to certain businesses and say, hey, look, we have this great opportunity for you. Or it's a great time for you to go to market and buy XYZ, or for you to sell XYZ and raise capital. Now, regardless of which side you end up on, whether you're on the buy side or the sell side of an M&A transaction, every M&A transaction has 3 steps or 3 phases. Phase number 1 is the pre-merger phase. And this is when all the due diligence takes place, the valuation, preparing of the marketing materials, and finding specific buyers. Phase 2, which is the negotiation phase. This is when you find specific buyers for the business, and then you're just finalizing and negotiating the final price. And then finally, phase 3, which is the integration phase. And this is when a lot of issues can arise, because this is when the deal's finished, but you're just integrating 2 companies together. Now, before I go into a lot more detail about these phases, I just want to take a moment and just to let you know that I'm not going to complicate this video by talking about divestitures, carve-outs, spin-offs, consolidations, merger reversals. If you want to know about all of these strategies and all of these mergers and acquisition type of transactions, as well as private equity type of transactions, then take a look at our investment banking interview and recruitment guide. Or alternatively, if you want to learn how we value all of these businesses and how investment banking analysts and associates really do their job on a day-to-day basis, then take a look at our financial modeling course where we go through on how to build a financial model step by step. And there are hundreds of Excel exercises for you to follow along with and for you to get practice to the point where you will be able to build a full-fledged financial model. And we go through everything from how to do comparables analysis, present transactions analysis, how do you build a DCF, an M&A model, accretion dilution model, and even an LBO model. Everything which you're expected to know in investment banking as an analyst and associate will pretty much show you exactly how you're supposed to do it. Okay, so now let's go through each step of the M&A process and learn exactly what investment bankers do in order to get a deal done. And the first phase is the pre-merger phase. Before you can start working on any type of M&A deal, you first have to win the deal. And the way that banks win deals is by pitching for business. So, junior investment bankers, analysts and associates will often be working on pitch decks. And pitch decks are some of the most tiresome documents that you will work on because you might be working on some of these till the end of the night, till the early morning, and the reality is they might not even be used by your managing director. But if you want to see what actually goes on in pitch books, how you make a pitch book, the different types of pitch books, then take a look at our investment banking interview and recruitment guide because I really don't have 6 hours to go through all of that here. Okay, so let's move on to another aspect of phase one, which is due diligence. And this is one of the most important parts of phase one. If you think about it from a real estate perspective, anyone can go up to a real estate agent and say, "Hi guys, I want to sell my house on 34 Laughter Lane." But what the real estate agent might not know is that you don't actually live on 34 Laughter Lane, but it's in fact your neighbor who lives there. And you're just trying to get rid of your neighbor. So in order to prevent fraud, investment banks have to do a lot of due diligence in order to make sure that you own the business, in order to make sure that the business is allowed to sell certain products, that the business has certain patents, they have intellectual property, they actually have this distribution channel in place, they have a customer base, and they have stocks in the warehouse. And there's a lot of due diligence which takes place, and you can pretty much call on lawyers, auditors, even consultants to help out during the due diligence phase. Now, due diligence can take anywhere from a couple of weeks to a couple of months, but it's very important for three key stakeholders. First, the buyer, because the buyer needs to be assured that they are buying a functioning business and that what they are reading or what they are signing is what they are going to get. And then the seller. The seller needs due diligence on the buyer to make sure that the buyer can actually afford to pay what they are claiming that they can pay. And then finally, the financier. If the buyer is going to raise debt or get leverage in order to buy this company, the financier needs to make sure that the business is real and that the buyer has enough collateral in order to keep up with the repayments and pay back the principal. So the buyer, the seller, and the financier needs reassurance, and the only way that they get reassurance is by doing a deep dive on the due diligence. Now, whilst this is going on, investment bankers also need to check on regulations. Now, this doesn't always apply to every single deal, but it can affect the viability of a deal. Now, there are some regulations that you have to keep in mind, and again, this is going to be different depending on where you are in the world, but in the UK, in the US, there are some pretty famous ones. So, for example, some of the regulations that you have to keep in mind is the US Securities Act of 33, and the Securities Exchange Act of 34, the SOX Act of 2014, and Dodd-Frank in 2010. Now, that was for US regulation. In Europe, there are some pretty very common regulations which you also have to keep in mind. And the number one is the EU merger control of 02 and the EU merger reform of 04. And in recent time, the European Competition Commission have also interfered in some merger deals. And one famous case was when UPS, the logistics company, tried to acquire TNT back in 2013. But the European Competition Commission intervened and prevented the deal from going forward. So it's not going to affect every single deal, but high profile deals where you have companies with a significant amount of market share, and if they are about to merge, then you are going to have to seek approval from the regulations. But for UK, there is pretty much the FCA and the Competition Commission of 2008 that will interfere if they perceive that competition is about to get significantly reduced or there is going to be a huge imbalance of market share. So if there are 3 competing companies in an industry and 2 of them are about to merge, then that's going to significantly reduce competition. And regulations are in place in order to prevent that, because they need to make sure that there is healthy competition in every single market so that there is no dominance or no monopoly that's going to form. So whilst all of that is taking place in the background, and again we are still in phase 1, junior investment bankers are going to start drafting a much more comprehensive version and a much more detailed version of the company's financial model, as well as start drafting the company's marketing material in order to present to prospective buyers of the company. Now, if we're talking about a sell-side M&A deal where we are trying to sell a particular business or a division, then we have to start creating a list of potential buyers that we can approach. And this list is going to be separated into tier 1 and tier 2. And tier 1 is going to be companies which we have a high conviction that they are going to be interested. Tier 2 are going to be other companies as well. Now, there are 2 types of buyers that we can approach. The first type of buyer is going to be a strategic buyer. So this is going to be a company that is going to buy another company because they have synergistic reasons. So they're trying to buy out their competitor, or they're trying to buy out another key area in their distribution chain. So for example, if we're talking about Tesla by Elon Musk, if Elon Musk wanted to sell Tesla, we would make a tier 1 list of other European car manufacturers in Europe, Asia and US. Now that's going to be your strategic companies. There are going to be another list of financial companies. Now financial companies are going to be private equity firms. Now in my experience, whenever we're dealing with a sell-side M&A deal, it's most likely going to be that private equity houses that are going to want to actually get the deal done, because private equity firms, they are in a rush to close the deals. Now whenever we're dealing with companies, they're not in a rush. There is a lot of bureaucracy, there's a lot of files, there's a lot of documents which have to go through, and by the end of it, you can pretty much kill the deal because it's just taking too long. But when you're dealing with financial buyers, with private equity firms, they're in a rush and they want to get the deal done as quick as possible. But the downside is they want to get the deal done at a much favorable price. So they are literally going to rip apart your financial valuation, and they're going to want to prove every single one of your assumptions wrong, and they're going to want to prove your methodology wrong just so that they can justify a much lower valuation than what you are trying to sell it for. So let's say we've identified a couple of buyers and we send them preliminary marketing material. And if they're happy to proceed and they want to know more, we will then get them to sign an NDA, which is a non-disclosure agreement. After they've signed that, we will then give them a lot more detail on the specifics of the company, from the company's financial valuation position, the actual name of the company, and pretty much everything that they need to know in order to be confident that they actually want to proceed with making the deal. And that's when we start with phase 2, which is the merger negotiation phase. During the negotiation stages, that's where the financial models really come into play. Because as I've already mentioned, you have buy-side investment banking and sell-side investment banking. You have the buyer that wants to pay the least amount possible for the firm, and then you have the seller that wants the highest valuation for this company. So you have financial models from each side, the buy side and the sell side, and you have to come together and agree on the final price, as well as liabilities and anything else which needs to be ironed out on the contract before everything is signed off. Now, just because someone offers the highest price doesn't necessarily mean we are always going to go for that one. The point of negotiation isn't necessarily just to iron out the final selling price, but it's also to get clarity on how is the deal going to be financed. Is the buyer going to finance the transaction via cash, or is it going to be a mixture of debt and cash, or is it going to be a share offering? And depending on the actual seller itself, all we can do is just to advise the seller on which deal is far better, but at the end of the day, the seller has the final say as to which of the deals or which of the bidders that they want to accept. And as I've already mentioned, in terms of closing the actual deal itself, you're far more likely going to find private equity firms who are going to be much quicker to close, because it's in their best interest to actually get the deal done and to start their process. Whereas strategic partners, so companies that wants to buy out other companies, they have to go through a whole process of due diligence, corporate governance, and then eventually, if it meets certain criteria, that's when they'll actually offer a certain amount. But nonetheless, that whole process takes a lot of time, and you can far more easier get the deal done much quicker with a private equity firm than with a corporate strategic firm. Now, it's also worth noting that as a junior investment banker at this stage, during the negotiation stage, if you're a junior investment banker, whether you're an analyst or an associate, it's not necessarily your job to take the client through the whole process here. This is far more the job of the managing director and the VP. The job of the managing director is to essentially go out and win business by overpromising everything. And then to actually get the business, you then have to control your client's expectation and walk them through to the final process, to actually selling the company if it's a sell-side M&A deal, or buying something if it's a buy-side M&A deal. But as a junior investment banker at this stage, you pretty much just have to get the valuation done, explain your assumptions, explain your methodology, pretty much that's it. But to actually get the deal across the finish line, to actually get the ink on paper, that's the role of your managing director, to try to get that whole deal across the line. As a junior investment banker, your role is pretty much around phase 1 and halfway through phase 2, but that's it. But from this point on, it's the job of the managing director and the VP to actually get the deal done. So now let's take a look at the final stage of the M&A process, which is the post-integration process. Now, this has a whole set of problems on its own, but essentially at this stage, you're pretty much putting the deal together and you're wrapping up the company and you're just merging them. Now, there are a couple of problems which can occur during this current phase. Now, in my experience, I was in the cross-border M&A team, and cross-border essentially means the international team. So I would be dealing with buyers and sellers all across the globe. So we have a buyer in London, a seller in the US, a buyer in Singapore, a seller in South Korea, and you get the idea. Whenever you're dealing with cross-border clients, we have a whole new set of problems. So for example, currency fluctuations. So whenever we're dealing with companies or buyers and sellers who are located in a region where there is a high fluctuation of their currency, we always advise both parties to get a currency option so that they can hedge their exposure, so that the amount that they're going to get in terms of converting their currency, it's fixed. So when they agree the price and when they actually accept delivery, it's fixed. And this issue of currency fluctuation, it's not just for really developing countries. So for example, whenever the US is imposing new sanctions on Russia, the Russian ruble tends to dive. Turkey is another recent example. And there are a lot of countries around the world where their currency is not fixed and it's pretty much volatile. So you have to make sure you can hedge against that. Another common issue is political instability. Now, outside of Northern America, Europe, you tend to find political unrest, and you don't really find the same level of political stability as you find in certain regions of this world. So you're always under threat of nationalization, of excessive regulatory controls, corruption, bribery, new taxes, and unfortunately these things you can't really project or control. Another thing which is increasingly becoming an issue is civil war and corruption. Now, with the Arab Spring, with unrest across South America and other parts of this world, unfortunately, the threat of civil war is increasing and corruption is increasing. So dealing in international investment banking is becoming an even more complex area to deal with. And then we have another issue of taxation. Now, not every country's taxation policy is the same. So, for example, in the UK, if you were to sell a company, the first 10 million is tax-free under a provision of entrepreneur relief. Now, not every country has that, but these are some of the things that you have to take into consideration when you're dealing with different countries' tax laws. And you have to either hire a tax accountant, or you have to read up on every country's tax laws to actually get a better understanding as to what is the best way for the buyer and the seller to actually make this deal as tax efficient as possible. And some deals are made on the premise of just being a tax efficient saving entity. So you have to really be careful when it comes to taxation and legal regulatory controls. Another issue is cultural norms. Now, when you're dealing with a company in Saudi Arabia and when you're dealing with a company in Hong Kong or South Korea, the cultural norms are very, very different. From how you even speak to management, from how long it takes for you to actually get data or emails back from them. There is a lot of cultural norms that you have to understand and adapt whenever you're dealing with people across the world, as well as language as well. And language is a huge asset whenever you're dealing in international M&A. But nonetheless, whenever you're dealing with companies and people across the world who have really different cultural norms, you have to be able to understand that and adapt to it. And if you don't, it can be a hindrance, and it could pretty much terminate the deal if you're not comfortable with dealing with different people from different backgrounds. Now let's talk about the actual process of combining two companies together. And this is not an easy thing to do, because there are a lot of internal governance, internal restructuring that's going to take place in order to incorporate another company joining in the business. And one of the biggest things that you tend to find is the threat of redundancies. So for example, when you have two companies merging together, and each one of these companies have their own separate head office. Now, since they're both becoming one entity, there's no point of having two head offices. So you can just pretty much fire everyone in one head office and just use the main head office. So that's just an example, but essentially the threat of redundancies is real whenever you have a major M&A activity. Another one is cultural shock. So if a company from Japan is buying a company in the UK, or again, you can pretty much imagine different parts of this world where you have different strong cultures, you do have to adapt to a new set of rules and standards if the parent company is from a different part of this world. And then you can also have the loss of key individuals. Whenever there is a M&A process, and if you are in fear of losing your job, you pretty much tend to go out and start shopping for a new role. But the loss of key individuals in certain divisions can be a huge problem when you're trying to combine the two companies together. And then another problem is failure to extract synergy. Now, the whole point of two companies becoming together is so that they can add more value. And synergy is pretty much 1 + 1 = 3. When you combine two companies together, they can have a much bigger output. But sometimes your financial model can say X, but in reality you get Y. And when that happens, you can pretty much lose a lot of market value. And you can even become a target for other companies to try to acquire you because your shares are so depressed, and it's a great deal for them to acquire you right now. And then you have other issues, for example, lack of incentive for the new management team to perform at a higher standard. Overpayment could be another issue as well. So those were pretty much some of the key issues or key problems that can occur whenever you have an M&A deal. Now, we go through a lot of these and into a lot more detail in the financial modeling course, so I highly recommend that you take a look at that. If you are interested in learning more about M&A, investment banking, or if you are in the process of applying into investment banking, or you are interested in a career in investment banking, it's really important that you know this in order for you to stand out during the interviews. Now, the one common question that I get is, what is the one factor which you need to know in order to construct a successful M&A deal? And the reality is there is no one overwhelming factor. There are many different factors depending on the company, the industry, and the current market timing, and the actual buyer and seller itself. Are they even a good fit? But nonetheless, if I had to choose one factor, it would be price. If you can get a deal done for pennies on the dollar, and even if you cannot extract the expected revenue or cost-cutting initiatives, even if you lose key individuals, it doesn't really matter because you've got the company for pennies on the dollar and you can still recuperate some value from it. And this is why you find private equity firms will fight tooth and nail in order to get the lowest valuation possible, because they know that if they can get a deal done at a really cheap enough price. Even if the company fails, it doesn't really matter because again, they got it at a really good deal. So they don't have to work that hard in order to extract a lot of value from it in order to justify the initial investment. So as usual, like this video, subscribe, and I'll see you in our next video. And if you want to see the written version of this video, I pretty much have a link of this article on our website. Check it out in the description box below.